Inheritance tax planning tips, business relief and discretionary will trusts. Using business relief qualifying investments can offer inheritance tax benefits. I'd like to explain how. As financial planners, using business relief qualifying investments can be a very effective means of inheritance tax planning. A business relief qualifying investment will be exempt from inheritance tax once it has been held for 2 years. This makes it especially attractive to those of you who are concerned that you may not live for 7 years due to ill health or advanced age, and you may already hold business assets. So how can this effective planning be made even more beneficial? Is it possible to benefit the next generations? How can we crystallise the business relief at the earliest opportunity? Can the assets be protected? The answer to these questions involves combining the business relief inheritance tax exemption with a discretionary trust held within the client's will or within your will, updating your will to direct any business relief qualifying assets which are exempt from inheritance tax into a discretionary trust has several key advantages. Firstly, it allows business relief to be crystallised on the first death. This is especially useful for married couples or civil partners, as it removes the need for the surviving spouse, civil partner, to maintain the investment until the second death, which of course may be many years later. The trustees of the trust can then hold the funds in a lower risk investment strategy, as the business relief exemption has already been achieved. So despite being exempt from inheritance tax, business relief qualifying assets are included in the estate of the owner for the purposes of the 2 million residential nil rate band taper rules. So directing the business relief assets to a trust on the first death will ensure the surviving spouse, the civil partner, can have access to the funds but not personally own them for taper purposes. In addition to benefiting the surviving spouse stroke civil partner, future generations can also benefit by using will trusts. Firstly, the assets are owned by the trustees of the discretionary trust, which means that they will not be included in the inheritance tax estate of the next generation, even if they have moved to business relief qualifying investments. Potentially, this could provide multiple generation inheritance tax planning. A discretionary trust will also provide protection for both the next generation and the surviving spouse, surviving civil partner, from events that can diminish family wealth. Generally, assets held on a discretionary trust are protected from future divorce, bankruptcy, and long-term care. In addition, assets are protected from future beneficiaries who may be reckless or extravagant. It's also important to note that a discretionary trust will still be subjected to the relevant property regime, which means that ordinarily entry, exit and periodic inheritance tax charges will apply. However, at the time the assets are passed into the trust, there would be no entry charge as the assets qualify for business relief. What follows is that there would therefore be no exit charge in the first 10 years. And for the purposes of the periodic charge, assets which qualify for business relief can be deducted to arrive at the chargeable value. Any specific advice regarding the creation of the will needs to be provided by a legal professional. This is someone obviously we can help you with, as we know plenty of specialist lawyers in this area. Hope that's been of help, and if anything pops up and you want to discuss this further, please get in contact.